p.m. live from our studio here in New York City. I'm Josh Lipton alongside Madison Mills. This is Yahoo Finance Live. Here's what we're watching this afternoon. We're an hour away now from the close on Wall Street, and stocks firmly in the green here. Markets staging a comeback during the session as tech leads the way. The Nasdaq outperforming, up more than 1%. We're tracking all the market moves.
And we're getting a check on the housing sector. Housing starts ending the year on a weak note, falling for the first time in 4 months this December. That's even as mortgage rates are declining. So we'll have what it all means for buyers later on in our program.
And getting behind the wheel with Ford CEO Jim Farley. Hear what he has to say about the softening demand for electric vehicles as the automaker doubles down on going electric.
We're going to get you up to speed on the market action. I'm just pulling up what we've got on the market moves here. No surprise, the S&P 500 Semiconductors Index, the best performer on the day. And that's why you're seeing a lot of green on your screen. An interesting reversal in the Dow that was pulled down heavily by United Healthcare. That holds the biggest weight in that index. We're going to talk about that a little later on. That's up 0.3%. Seeing green in the S&P and Nasdaq. S&P up 0.7% and the Nasdaq up almost 1.5%, 1.2% there as we head towards the close. And both the S&P and the Nasdaq driven by those big tech names. In that Magnificent Seven we always talk about, the only laggard today, Josh, is Tesla, as we see that upgrade on Apple driving the news, and of course those TSMC earnings driving the move forward as well. Yeah,
we did have some important earnings to chew over today. We also, Madison, had some important Fed speak today. You know, when our policymakers talk, we pay attention, especially when it's Atlanta Fed President Raphael Bostic. And the question is sort of, when the Fed is going to cut this year. This week we've heard some very smart economists and strategists kind of debating that question. Some we've heard thought it was earlier, some later. So here comes Mr. Bostic weighing in here, gave us his take on the timeline, said he doesn't see cutting rates until Q3. Yes, said he's open to the idea of cutting earlier if the evidence, the data is convincing in his words. Did say he has made adjustments in that timeline. It had been Q4. Now he says Q3. Bostic going on to say here, if we wait too long to begin adjusting policy, we run the risk of over-tightening the economy. And Bostic, of course, a voting member of the FOMC.
So that's another reason that we're seeing that green today, right? A little bit of a pushback to the higher for longer move potentially there. If I look at what the market's pricing in terms of the swaps market, about a 53% chance of a rate cut in March. That's a little bit off of around 56%, I believe, yesterday. Definitely down from around 80% of a chance of a cut in March that we saw on Friday. I do want to take a quick look at the yield curve. I like to look at this as an indicator of that recession watch, right? A disinverted yield curve, technically not a good indicator of what's to come in the macro environment, but yield curves are quickly normalizing. Yields on 10-year notes solidly above those on 5-year notes. That's after more than a year of inversion. We are still waiting on the 2-year, 10-year to disinvert fully. It's rallying strongly, but it is not yet positive. So we'll be waiting for a disinverted yield curve to come. If we get it in the 2s, 10s, I'm going to say that we're going to have a lot of green on our screen that day, because what recession? That's going to be the vibe.
We're placing your bets. Fortunately, we have some very smart market gurus come on the show today to talk about that data point. Absolutely. All right, here's another big mover in today's session we have to talk about. Apple shares on track for their best day here since May of last year. And it comes after Bank of America said the stock is now a buy and raised its price target to $225. Joining us now is the analyst behind that call, Wamsi Mohan, Bank of America Securities Senior IT Hardware Analyst. Wamsi, it is great to have you on the show. So, Wamsi, we saw this series of downgrades on Apple from your colleagues on the street kind of to kick off the year. But you come in, Wamsi, and you're telling your clients, nope, Apple is a buy. How come, Wamsi? Walk us through the argument.
Yeah, good afternoon. Thanks for having me on. Look, I think that the way we look at this setup is really where are estimates going. So back in September of 2022, estimates were too high. We thought that $6.50 in EPS was way too high. We thought it was closer to $6. That's what played out. That's when we had downgraded the stock. Now, as we're standing here at the beginning of 2024, we think that there is some significant upside to estimate revisions in 24, 25, and 26, and that's the action that we took today. Stocks are fully correlated in the long term with estimate revisions, and we think that Apple will reflect that in its performance. So the upgrade today is really a call saying that we have a high degree of conviction that estimates for Apple will continue to move higher over the next 3 years. And it's driven by several catalysts we can get into, but primarily it's about generative AI on iPhones. We think that that is going to be a major catalyst. Second, we think that the services revenue is reaccelerating. And third, we think the Vision Pro, while limited in its scope and capability to begin with at the given price point, has long-term potential, both on the hardware and on the services front. So we think there's ample room for a lot of things to go right over here where estimates will move higher.
And Wamsi, I just want to drill down there into the call on the iPhone, because it's interesting. What you see is this potentially multi-year stronger iPhone upgrade cycle. And as you were saying, Wamsi, to your clients, what you're banking on here is Apple's going to introduce these kind of new AI-enabled iPhones in 2024, 2025. I'm interested, Wamsi, as you think through that, what are the kind of new AI features that you think are potentially going to wow consumers here?
Yeah, absolutely. I think we have to bifurcate what is going to happen in software versus what is going to happen in hardware, right? When you think about the hardware, there's accelerated processing units, there's high bandwidth memory. These are all things that'll get introduced in calendar 25, not in 24. So the iPhone 16 will have a faster, the usual faster processor. You heard TSMC overnight talk about just how neural engines are getting embedded even more and more so on silicon. The die size is growing, so you will get some performance benefit. But what you also see is Apple is doing a lot of work on the software end of things where you can start to run LLMs in very limited hardware scenarios where you have limited RAM and you can expand this into Flash, and they've written papers about this. So what you're really looking at is initially a software-driven cycle that then morphs into both a hardware and software-driven cycle. In this year, what we expect is that iOS 18 will have a lot of AI-enabled features. You've already seen a preview of this, right? Like Galaxy S24 that just launched yesterday. You can see about all the real-time things that you can do in terms of translation, in terms of transcription, in terms of voice to text. There's a whole bunch of slew of things, features that have been introduced. I think Apple's going to do that and do that better. So that's what we expect in 2024. In 2025, I think it's going to be a step function change because some of the hardware is going to have more acceleration, more dedicated memory, and that is just going to change the game in terms of what you can do on device to a higher degree than what you would see even in 24.
Wamsi, you mentioned that Samsung, also Google, have beaten Apple to the punch when it comes to an AI-powered phone. What exactly are you betting on Apple to do better than those competitors?
Yeah, I think what Apple has that none of these other players do is really consumer-centric information that's stored on the iPhone, right? They're very concerned about privacy, and so the information never kind of leaves the iPhone. But if you think about every intention that you express, right? Like you want to travel, you go to your iPhone, you book something, you look up where you want to go travel. You want to go to a restaurant, the iPhone knows where you've been, right? So you've got perfect information in some ways. What does generative AI do? It takes high-quality data and generates inferences off of that high-quality data. Our contention is that iPhone has the highest quality data about any person. Their personal iPhone is the repository of all the history of their life, literally in their hands. And you take that and you say, well, what can we do with this information? Well, if you run Gen AI algorithms on a phone like that with that information, you can give really valuable, targeted advice and be a real assistant of sorts as opposed to the way that Siri functions today. So I think that it's more than what you can do in image manipulation and take away people from the background and add things in the foreground. This is much more central to improving productivity and actually using an assistant the way it should be used.
And Wams, just to switch gears here, Apple earnings will be here before you know it. And one issue certainly for Apple investors is going to be China. There have been worries, Wamsi, about China, the Apple's business there. Some are calling out potentially weaker demand. Some are looking at local rivals like Huawei. How are you thinking through that dynamic?
Yeah, absolutely. Look, I mean, China is a concern. We've not downplayed this over the last year. We've written many times that Huawei has become a force of nature in some ways, and you've got potentially Apple, which gained 15 to 20 million units over the course since the Huawei sanctions went into place, some of that to reverse. So let's say 15 million units or 20 million units over a 4-year period. We're talking about 5 million units a year headwind that's coming purely from Huawei taking back some of the share that it had ceded to Apple over the last 4 years. What is that in the context of Apple in a year, right? Like we're talking about 240, 250 million phones. We're talking 4 million, 5 million phones in China. That's a 10% decline in China, right? So we're already thinking about that. I think the offsets to that are really emerging markets. And if you think about all the countries that Apple has called out on its earnings calls over the last couple of quarters, it's called out India, it's called out the Philippines and Indonesia and a whole host of other Netherlands, right? And you normally sell anywhere between 1 to 10 million phones in these countries. There are also countries where you sell several 100,000 phones, right? When you add the cumulative total of everything non-China, that leaves 200 million phones. If Apple can take any share, which they are, across all these other regions, they can more than offset the weakness in China. So the China problem has to be encapsulated in the totality of what can happen in other regions, how much share can Apple gain in other regions, and when you look at it from that context, a few million phones plus minus is not really going to change our thesis on Apple.
Wamsi, I want to get you out of here on this, and it's about Apple's next big product, Wamsi. So the mixed reality headset, the Vision Pro. We've had some analysts, Wamsi, come on. They say, listen, near term, they don't think it's going to be financially material, but longer term, they're more optimistic. Where are you at?
Yeah, so it's funny to talk about financial immateriality when you can do $700, $800 million in revenue, right? Like 200,000 units at 3,500 to 4,000. That's the kind of number we're looking at. And yes, in the context of a $400 billion revenue company, it's not a big number, but in isolation, it really is. When you think about the size of the VR market, right, it's about 8 million units a year. It's about $4.5 billion. So Apple's already making a dent in its own category, right, in year one. We think over time, this is going to be a real game changer. The way we think about it is really anyone who has a Mac is potentially someone who could own the Vision Pro at $1,500 to $2,000 price point. We think we get to that price point in a couple of years. It's not immediate, it takes a little time. It gives time for development of apps, for a lot of the app ecosystem around Vision Pro to get a lot more better. But the place where we see the most opportunity is if we can build out an install base of several tens of millions of the Vision Pro, you can get very unique experiences of content, whether it be a concert, very immersive experience of that, or sports, which other people have tried and failed, but we would give Apple the benefit of the doubt in doing something like that, and then being able to monetize it. You can pay $20, $30, $40. I was in Vegas for the CES show, and I looked up how much U2 tickets were going for at the Sphere. $750 at the Sphere in Las Vegas. So $20, $30, $40 for an immersive experience. I think absolutely consumers would pay that. When you layer that on a tens of millions install base, it's a huge opportunity for Apple.
Wamsi, thank you so much for joining the show today. We appreciate your time and your insight on all things Apple.
Thank you for having me.
While tech is the top winner today, there are some other unexpected winners to start the year. Jared Blickery is here with all the details.
Don't want to give it all away, but we're going to get to healthcare in a second. First, want to point out that tech, XLK, this is the first record high of the year. This is a 2-month chart, and you can see after a little bit of a stumble in the early part of the month of the year, we have rocketed 2 new highs. And let's take a look at what's happened over the last year, because I want to point something out here. The 3 leading sectors are tech, communication services, and consumer discretionary. And if we look at the leaders today, we got 3 out of 4. We have to add industrials to that mix there, but let's take a look at what's happening year to date here, because it's very similar. We do have healthcare. I mentioned that before. That is the leader of the pack, but then guess what? We have tech, we have communication services. Now we insert staples into that. And guess what? We are looking at XLY as a leader over the last year. It is down 3.3%. That is largely a story about Tesla. Tesla is one of the biggest stocks there. Also Amazon, by the way. Tesla down almost 15% for the year. So that's explaining some of that. And tech would be a little bit worth a little bit more if Apple were not dragging it down this year. And I also want to point out the technicals in Apple. Not going to spend too much time here. We just had a great analysis, but on a technical basis, we just had liftoff from the 200-day moving average, and we are right now at the 50-day moving average. So interesting to see how this works out. And also, we do have a gap here to be filled around 190, 191. Once that potentially fills, then we'll see. That's when the rubber meets the road there. But so far, it's been a blockbuster year, not only for tech, but for some of these chip stocks. Here's NVIDIA up almost as much as Tesla is down, about 15% there. Here's AMD. We're taking a look at AMD having the first record high, intraday high here, since 2021. So that's been a long time coming. Finally notched that today. And I want to point out what's happening in the bond market before I move on, because the 10-year T-note yield this year has been on the rise, and that has been favoring some of these mega cap stacks that did really well last year under the similar circumstances. Also want to point out that the US dollar index is rising. That's a headwind for a lot of stocks, but not necessarily the mega caps. And then finally, want to round this out with a discussion of, and take a look at some of the leaders in RX. That would be the pharmaceutical space. And here we go there. Eli Lilly, after not the best year last year, but after a very good year, it is off to a nice start this year as well. And we can also take a look at Novavax, that's up as well. And then Amgen up 6%. And you squirt this by equal rate, you can see Vaxart, that stock is up 42%, guys.
All right, Jared, thank you as always for giving us such a great look at all of the market action there. We're going to continue the conversation with a check on a few trending tickers. We've still got about 45 minutes till the closing bell, but let's talk about the stock that's been driving the day. Shares of Taiwan Semiconductor jumping today, boosting other chip stocks as well, as its fourth quarter results suggest that the worst could be over for the sector. TSMC forecasting solid growth for 2024, seeing a revenue increase in the low to mid 20% range, driven by huge AI demand. What I found interesting and what folks on the floor of the stock exchange were talking about this morning was this idea that Apple is the biggest customer for TSMC. So what does that mean moving forward for Apple? Is good news for Taiwan Semiconductors, also good news for that name. Also, does it indicate a broadening? We've been looking for a broadening outside of the Magnificent Seven. Matt Maley today saying that chips moving upward is a bullish indicator for that broadening. I wonder if it just means that TSMC is going to be included in the Magnificent Seven more than a broader range of stocks being included there. But what do you think, Josh?
Wait, so Taiwan Semi, so the world's largest contract chip maker, right? So yes, chip maker for Apple, but it's NVIDIA, it's Qualcomm, it's a lot of names we talk about. So that's why we pay so close attention. And I think the money quote here that stood out to me from execs was, our business has bottomed out on a year-over-year basis, and we expect 2024 to be a healthy growth year for TSMC. You look at some of the numbers they were given, forecasting revenue growth of at least 8% to 18.8 billion. Consensus was closer to 18.2. They said budgeting capital expenditure of 28 to 32 billion. In 2023, remember, it was closer to 30 billion. Quick side note that I thought was interesting, though, here, apart from the earnings results, Maddie, was that they announced another delay to its $40 billion site in Arizona. Execs now saying their second plant will start operations in 2027 or 2028. Previously, it was 2026. And this coming, as we know, the Biden administration has really been intent on kind of increasing, domestic chip manufacturing. So this is being described as somewhat of a blow to those efforts. Absolutely
a blow, particularly as President Biden was going into his speech today on Bidenomics and the impact that was going to have to the jobs market, as he is in an election year for an election he is expected to announce that he's going to be part of. So interesting to see that TSMC becoming kind of the latest to announce some of those delays and what that will mean for the other recipients of the IRA funding on that front. Yep, for sure. And moving on here, let's check out another mover in today's action, Humana. That stock taking a hit on Thursday after the U.S. health insurer slashing its full year 2023
earnings guidance. So that was the headline here. They slashed the outlook. Adjusted earnings for the year, Maddie, will be $26.09 a share. The earlier forecast had been at least $28.25, and it sounds like costs of members' care exceed expectations. That's the issue here.
Yeah, it's interesting because this name brought down some of the other folks in the sector as well. I spoke with Jay Woods earlier today about Humana pushing down United Health, which you can see down 2%, but that was really driving down the Dow Jones in particular today. CVS also down a little over 4%. It's interesting because technically the stock has been in a wide range from 450 to 550. Previously, when I talked to Jay about this name, he said that if it broke out of that 550 range out of earnings today, UNH could have been a good stock to invest in. Obviously, that did not happen. So based on that news today, he's saying that UNH is a stay away stock for now.
Now, interesting, because here's another side, though, because there are some on the street, like the team at Cowen, who say the sell-off is a buying opportunity. Still like it. They think kind of medical cost trend likely kind of moderates in their opinion. And really, when most are still bullish on Humana. Lots of love on the street. 18 buys, 5 holds, no sells.
Yeah. I mean, he did. I also should mention that Jay said if he was still a day trader, the day trader in him would love to short the stock. So there is that opportunity for this name as well. I do want to get over to some of the bank earnings. This is the conversation we continue to have here. Discover Financial Services in the red today following a big profit miss for the fourth quarter. Adjusted EPS coming in at $1.54. That's well shy of the street's estimate that was $2.52. The big headline number here, Discover's net interest income, 62% decline year over year. If that wasn't bad enough, the forward guidance dipping over 10% depending on the interest rate outlook. And the interim CEO saying, and Josh, that this came after some compliance issues, some C-suite shakeups. The interim CEO said we've taken steps to strengthen our risk management and compliance programs. Those steps were not enough to help this stock today.
Yeah, I'm just looking through the analyst notes after the print here. What's the reaction? Some acknowledging results. Listen, they say it came in weaker than expected on these higher provisions, operating expenses. The 2024 outlook, they'll know it was weaker than they were looking for. Though, those same analysts will talk about, silver linings, as they put it, net interest margin expectations, perhaps conservative, they're telling their clients, and maybe we'll see reinstatement of share repurchases.
Yeah.
Stock, though, down about 13% now over the last 12 months.
It's just been so hard for these regional banks to recover from the collapse of Silicon Valley Bank and from rate hikes that have not only impacted the larger banks, but also the smaller banks, as there's been this deposit flight. We haven't seen a lot of recovery in that space.
All right, we'll keep watching. We are just getting started here on Yahoo Finance Live, but coming up, more coverage from Davos. We'll hear from the CEO of BNY Mellon and all things banking, from AI to interest rates. Plus, Ford CEO Jim Farley has big plans for the car maker in 2024. That conversation in the 4 p.m. hour. Stay tuned. More Yahoo Finance after this.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
One lesson we're learning here at the World Economic Forum as part of Yahoo Finance's coverage is that some of the largest and oldest global companies are being completely reinvented by artificial intelligence. Let's talk to one of those companies, that is BNY Mellon President and CEO Robin Vince. Robin, good to see you here. Your company's 240 years old. Did we get that stat right?
Yeah, you did. It's great to be with you, by the way. Thanks for having me here in Davos. Yeah, this is our 240th year. We were founded by Alexander Hamilton. We're actually the oldest bank in the United States. But to your point earlier on, we are in a transformation.
How are you implementing AI in a company that is 240-year-old?
Well, you only get to be 240 years old by continually reinventing yourself over the years. We've been part of a lot of innovation and transformations over the course of our history. And last year, in 2023, we just announced our results last week on Friday. We really started to invest quite deeply in AI. We created an AI hub, and it's creating benefits for our clients. We have a service now that we deliver to clients that helps them to be able to see in the treasury market what's likely to happen next in the post-trade process. We also use AI to be able to help our research folks get a start on the day, a draft writing of the research, and then they come in a little later and they can obviously polish it up, improve it, but it creates efficiency for them.
What are you hearing from your clients about these kind? I mean, it sounds like you're using it a lot internally as well, but we've been sort of trying to figure out what the push and pull is when it comes to these type of AI services.
Well, AI is all the rage at Davos this year. As you probably know, the main promenade sort of converted from crypto to AI, it feels, for the week. But our clients are excited. They're curious. They are a little cautious. They're not quite sure how it's going to happen, and that's where we bring our platforms at BNY Mellon to them to help them to navigate all of this, because that's really what we are. We're a platforms company that helps our clients to navigate what's going on in the world. And so in the case of AI, they do look to us to help create solutions that ultimately is going to make their lives easier in the investment process.
You mentioned crypto. Are you ready to make a big bet on crypto in light of what we have seen with the spot Bitcoin ETFs?
Our focus has always been, Brian, on the digital asset ecosystem more broadly, tokenization. How can assets that maybe haven't been part of the financial system be brought into the financial system and be easier to transact, to move, to manage, to store, which is really the heart of our business. And so that's our primary focus in the tokenization digital asset space.
So we've talked about AI, we've talked about digital assets. Let's talk about the core business of banking and what affects it, namely interest rates, right? You've talked about that your net interest income is going to come back a little bit as we start to see changes in rates. What are you expecting on rates this year?
Well, we have a great vantage point as a company, and we're very privileged with our business, with our clients. We touch about 20% of all investable assets in the world, and about 40% of our revenues come from outside of the US, so we have that global reach. So the answer on rates depends market by market, but to the US. Sure. So in the US, I think the Fed's done a pretty good job in navigating everything that they've had to deal with. You know, we had COVID, we had a surge in inflation, we've had the longest, quickest campaign in rate rises in 40 years. We've talked a lot about that. And so far, people are still talking about the possibilities of soft landings. Now, that's going to be super hard to pull off. It hasn't happened in recent times, certainly not with this backdrop. We're rooting for it, no question, but we're in the preparedness business. So we help our clients to be able to manage whether or not rates are going to go up or down. Now, it's our house view that we will see rate cuts this year, maybe a little less than what the market's expecting right now, and maybe a little later as well, but we'll have to see.
We're hearing from a lot of international investors a level of concern as we near the presidential election. When you talk to those international clients, are they wanting to, or do you think they'll pull back on how much they're investing in the United States in the lead up to the election?
Well, I was at an event yesterday, actually, and it was interesting that there were several European leaders there, including some heads of state, and there was this conversation around the fact that people around the world have to prepare for the different eventualities of what can happen in politics. We have half the world's population going into elections this year, so it's not just about the US. We've got other important elections in other places. But I think it's right, and this is, again, back to us, we're in the preparedness business. Our clients need to be in the preparedness business. They expect us to help them. So navigating whether something happens one way or another way, you've got to be prepared. You can't roll the dice on these types of
How are they
things.
preparing?
Yeah.
Oh, well, you can be prepared by looking carefully at your business, by investing in whether rates might go up a little bit or whether they go down a little bit. Is the stock market going to have a good year or is it not going to have such a good year? How do you get your business? Resilience matters. We learned those lessons in 2023. We saw that if you're not prepared from an asset liability management basis, you can get yourself into trouble. That's what happened in the spring. If you're not operationally resilient, you're not there and ready for cyber. We help to try to wrap our platforms around our clients so they can be resilient to more types of things.
Lastly, quickly before we let you go, do you expect a more risk-off environment in markets in that month or two before the election?
Look, the way that markets play out, markets don't like uncertainty. And so we'll have to see how the election in the US is playing out at a given moment in time, and markets are going to react to that. But markets have a pretty good ability to look through events and look through into the future. But uncertainty isn't helpful. And so again, you've got to be ready for that.
Unhelpful indeed. BNY Mellon, President and CEO Robin Vince, good to get some time with you here at Davos. Really appreciate it.
Great to be with you, Brian, Julie. Thank you so much.
Thank you so much. Appreciate it.
Stocks higher here on Thursday as markets look to fresh quarterly earnings for inspiration amid a rough start to the year. And while we are slowly swinging back into the green, how do investors need to approach investing this year? Our next guest points to two major themes for investors to be focused on. Brett Nelson, Goldman Sachs, head of tactical asset allocation for ISG, joins us now for more. Brett, it is good to have you on the show. And I want to start here, Brett, with just some high-level themes for you. And one is, you want to stay overweight U.S. equities here in 2024. How come, Brett? What are sort of the factors underpinning that argument?
Sure. Well, thanks for having me. So we've had since 2009 two investment themes, as you mentioned, one of which has been U.S. preeminence. And so when we talk about U.S. preeminence, we're talking about the very unique combination of the U.S. of having not only the largest GDP in the world, it represents 26% of world GDP, but it's also among the most wealthy countries in the world, in the top 10 in terms of GDP per capita, as well as the fact that it has vast natural resources. Many people are surprised to know that the U.S. has the most arable land of any country in the world and is the largest exporter of agriculture. You'd think Brazil, et cetera. And then the final point is it has the largest and deepest financial markets. Its financial bond and stock markets are about 6 to 7 times the next largest country, which is Japan. So the reason all that matters from an investing standpoint is because that has translated into superior earnings growth. Since the third quarter of 2007, when earnings peaked in the US, earnings have doubled in the US versus being up 22% for the MSCI X the US. And that has also then therefore translated into superior stock performance. So since the trough of the global financial crisis, US equities have annualized at 16% per year. That's 7 percentage points higher than what we've seen in non-US developed markets. And we think that will continue this year. We have a target for the S&P 500 of 5,000, so we're expecting about 6% earnings growth. But unlike last year, we think that will be driven more by earnings this year, with the S&P 500 being up 6% by the end of the year, but driven by a 7% increase in earnings. Whereas last year, as you'll recall, most of the return came from PE expansion, or the multiple going higher.
So, Brett, I'm curious then, what specifically should investors be keeping their ears open for when it comes to earning calls throughout this cycle? What is noise versus what is going to move the price action?
Yeah, I mean, it's very important. Last year was largely driven by multiple expansion. And so investors obviously don't need to see as many individual milestones as you do with earnings, because it was essentially the pivot in the Fed later in the latter part of last year that allowed investors to want to pay a higher multiple for stocks. Now we're in more of a show me phase where investors are going to be a little more reticent to pay forward given multiples are already elevated. So the good news for Q4 earnings, which we're in the process of seeing now, is that we think that the hurdle is relatively low. Typically between the end of September, the end of the third quarter, and the end of December, you see negative revisions to earnings. They're down about 4 to 5%, the expectations. This year they fell by 7. So we think that there's a relatively low hurdle for companies to beat that lowered bar. And we also think margins could be the thing that would surprise to the upside. Consensus is expecting margins to fall by over 100 basis points from Q3 to Q4. That would erase all of the margin gains that companies accumulated over the course of 2023. And we think that's a bit draconian. So we're going to be looking very closely at margins, and also the fact that, we had strong economic growth in the fourth quarter. At the end of the day, corporations are paid in nominal dollars. And so we think that nominal GDP growth will continue to lift sales.
And Brett, as you look out to 2024 here, what are the big risks, Brett, that you think investors need to consider?
Well, there's no shortage of things which keep us awake at night, as I'm sure for you all as well. But the one thing that we're really focused on is the dynamics in the Middle East, and in particular, the Israel and Hamas war, as well as the involvement of Iran. Now, so far, that's been a relatively contained, issue that's been going on there. We haven't seen that broaden significantly into a regional conflict, but that's really the main risk. And specifically, that would be mediated into the financial markets through potentially a spike in oil prices, or if not that, then obviously disruption to shipping. And we're seeing some of that. And of course, we recall from the pandemic, having seen this movie before, when you get big disruptions in global supply chains, that can feed through to inflation, and that ultimately might impact the ongoing expectation for rate cuts this year, of which, we're expecting 4. So those are all the things we're looking for. The one thing I would note, however, is that unlike past periods, we do have a very large excess capacity of supply in oil. OPEC has obviously been withholding oil from the market, and so their spare capacity is at multi-decade highs. That should act as a shock absorber if we were to see some disruptions related to the wars in the Middle East.
And Brett, one other risk, one other variable to consider too would be the election, right? It's an election year. It looks like, listen, it could very well be Trump and Biden. How do you think investors should navigate an election year here?
Well, it's quite interesting, actually. We've looked back historically at this question. And when you look at election years of first-term presidents, what you see is that in every single one of those years in the post-World War II period, the equity market has actually been up by an average of 12%. When you contrast that with second-term presidents in an election year, the market's actually been down, with only about 40% of those years up. And so we think this has something to do with when a president is trying to be reelected, they're typically doing policies for businesses and the economy that are friendly, and that has generally worked out well for the markets. So it could be certainly a source of volatility. I think the person who was on before me was talking about the market not liking uncertainty. But generally, those periods of uncertainty have been short-lived, and the market tends to rejoice once the event has passed, regardless of who's elected, just because now you know what the contours of the playing field are going to be for the next 4 years.
Brett, finally, we know that the Senate passed a stopgap spending bill moving to avert that shutdown. It now, of course, goes to the House. But I'm curious, to what extent do you think that these funding questions that are coming up in Washington are going to define market movement, or is it, again, just a little bit of noise?
Yeah, I think the history on this one is also pretty clear. I think that we've seen these shutdowns before. They're obviously disruptive. They're a source of short-term volatility. But very consistently, the market has tended to look through these. They know the government's not permanently going to be shut down. And they also know that the pressure ultimately builds on both sides of the aisle once Social Security checks and other things are at risk of being delayed. And so these can be, political theater, negotiating tactics, et cetera, but they're not the types of things which are ultimately going to drive the fundamentals of the market, which we think are more the economy and whether you have a recession. Again, with our probability of a recession this year being 30%, that's certainly not our base case.
All right, Brett, we'll get you out of here. Thank you so much. Next time, I want to talk about how you're overweight Brazilian stocks, because I thought that was really interesting, but we'll let you go for now, Brett. Thanks again. Now, coming up here, Yahoo Finance at the 2024 World Economic Forum. And after the break, Brian Sawley and Julie Hyman speak with Williams-Sonoma CEO Laura Alber about how artificial intelligence is impacting consumers. You won't want to miss that chat after this break.
in addition to all the conversations about AI and geopolitics here at the World Economic Forum in Davos, there's a lot of other conversations going on, interesting sessions. They did a live session from a deep sea submersible where Ray Dalio talked. He's an investor in OceanX, the company that does that. So there's a lot to sort of absorb and then take away back to people's businesses. One of the people doing that is Laura Alber. She's the CEO of Williams-Sonoma. And there is so much to take in, Laura. And obviously, your business is one that you don't immediately think geopolitics, for example, when you think about Williams-Sonoma and its various businesses. But obviously, you get a lot out of being here. So talk to us about what you're hearing this year and what's interesting to you.
Yeah, you nailed it. I mean, there's the dichotomy between all the very difficult news, the uncertainty, the fear, and then the optimism around the new technologies and how they could really change everything that we do in a good way. So there's those two things, and then there's all these other conversations that are quite interesting. And I think it's great to come here and not just go to the things that you're scheduled to do, but to wander around, meet new people, and go to sessions that are unexpected and see what you can learn.
Yeah, serendipity is a big part of Davos, for sure.
Laura, there is a lot of AI talk here. It's all over the place. What do you think could be applied in terms of AI to your business? Is it the buying experience that I go into your store that will change, or is it more back-end system stuff?
There's a bunch of different things that you might be surprised to hear. I mean, the most obvious is tailoring our marketing messages to you. So making it more relevant, using patterns to do that. And that's something we're doing with email marketing with Salesforce. It's exciting. In addition to that, we're seeing great benefit on the supply chain side. So decisions about shipping and where to ship from and together or separate and from store, all those things that we used to make decisions on as individuals are now being optimized. And we can optimize it for time or we can optimize it for cost. And that's super cool. It's just yet another example. And then there's the obvious things like, using it as a co-pilot for customer service to help the person who's on the phones handle any service issues that might come through, to give them, and we're in the nascent stage of that, but to give them more information about how to better serve the customer. And I think that will be a big piece in the future. And then of course, copywriting on the website, whether it's natural search or other copy that we can really leverage the AI for.
And since you mentioned logistics and supply chain, just briefly, that reminds me of what's going on in the Red Sea and some of the difficulties through there. Is that affecting your business at all?
Yeah, of course. I mean, it affects most people who are shipping. And there's alternatives, but you've got to be on top of it and talking to your carriers to make sure that you're getting your goods. We have let our customers proactively know. We changed our lead time dates. There are some customers who got a delay, right? Who had already ordered and thought they had a date, and we pushed it a little bit. But what we're doing now is if you go to order a sofa, you're going to get the padded date so that you're not disappointed.
Right. Is it raising your costs?
We'll see.
Yeah. And are people more understanding of those delays post-pandemic? Because the delays were so extreme during the pandemic.
You still get your stuff, right?
Oh, I finally did.
Okay.
It only took me like 9 months to get a couch, but not from you guys. But
well, why isn't it from us?
Sorry. Oh yeah.
So
we'll talk about that. We'll talk about that after. We'll talk about that.
I could ask you a few questions.
We'll talk about that after. But so are your customers know more, because it's all relative, right? Are
Yeah,
they a little more understanding?
People want their goods, and they think we have the magic button to get it to them on time, and so we do our best.
Laura, one thing I've been reminded about, 4 or 5 days we've been here, there's a new generation of homeowners, new generation of people living in ways that didn't live like they lived 25, 30 years ago. What are they shopping for in your stores?
Give me an example of what you mean by they're not living the way they used to.
We just talked to the CEO of Suntory, and he was talking about Gen Z consumers not consuming as much alcohol as their parents for health reasons, which was like, yeah, I guess that maybe applies
that
to me.
That might be what they're saying.
Yeah, I mean, but what are you seeing like a different shopper come to your store, and how are you designing things differently?
I don't know that I think it's that different. People are people. Right now, everyone cares so much about health and wellness. That's, I think, what's on everyone's mind. And so we're so lucky that we have so many products that address that in different ways. And we all know that eating at home is the healthiest thing you can do. When you make your own food, you know what's going into it, less salt, less sugar, less fat. And so it's exciting to see all the products that support that.
one of them that, we love talking about our favorite products every year that is so good is the Tucci pan. I don't know if you've seen the Stanley. So we did a collaboration.
Like Stanley Tucci?
Stanley Tucci. We did an excellent collaboration with him this year. Beautiful product with green pan. And go to the stores and take a look. It's a wonderful big collection. I love the multi-pot, colors, modern design, and high performance, clean cooking.
I like to envision your kitchen whenever we talk to you. Laura, one of the things that you've done strategically that I find really fascinating versus some of your competitors is you've held the line on price, pretty much, right? In other words, when we were seeing rampant discounting, that's not really something that you did across your different lines. And it's helped you margins-wise, even though sales-wise it hasn't necessarily helped, but investors have liked it. How did you make that decision to do that?
Yeah, so, the right price the first time that's better than your competition is the answer. And if you do up and down pricing, you're actually competing with yourself, because furniture is different than other things. You don't really know how much this table should cost, right? You could come up with probably 5 different answers, any one of which could be correct. But if this table used to be a different price and we then discount it, you do remember that. So, as a good shopper, it was really obvious to me that this was a problem, but yet it was the way the industry was going. So during the pandemic, when all bets were off in the very beginning, where we didn't know what was going to happen, we looked at each other and said, how do we want to run this business? What are our values? And we didn't know if we'd be in business a year later because they were shutting down everything, right? And so we made the decision to stop the discounting then. And it took us a little while to gain our courage, but now it's the way we run the business. We do take markdowns. So if there's something we buy too much of or it doesn't work, just like you would expect, we take a markdown.
Do you think this could be a pretty big year for the home furnishings industry? A lot of the comments that we've talked to, Julie, maybe have rallied around a consensus of 3 rate cuts. Maybe that might mean more people buying homes. How do you talk about that internally?
Yeah, so I hope that's true. There's also a negative version of that conversation. I don't ever plan our business based on the macro. The only way I can think about it, and that we think about it as a team, is as if it were the same as it is today. And so we're not relying on the macro to either drive it up or take it down, and to say, what is the innovation, what are the efficiencies that we have that will make customers come to us versus everyone else.
Laura Elber, thanks so much. Really appreciate your time.
Thank you.
Welcome back to Yahoo Finance Live. I'm Senior Health Reporter Anjali Kimlani. A lot to discuss when it comes to the private sector in healthcare and all the deals that are made and all the innovation that is taking place. But the federal government is starting to take a closer look. Here to speak with me now is Renee Wegerson, the first director of ARPA-H. It's just like DARPA, but for healthcare, and is focused on bringing innovation to the fore for the industry in a similar way as we've seen with the federal government in the past. Renee, thank you so much for joining me today. I know, you've been pretty busy since the organization and the program was founded in 2022. I'd love to get a start on Heroes and just a call to the private sector that you're going through right now. Let's talk about that.
Yeah, absolutely. Well, thank you for having us and hearing a little bit more about what is ARPA-H and what is our model, what are we intended to do here in the ecosystem. So as a brand new government agency, as you said, we are modeled after DARPA. So to go for those really big breakthroughs, but instead of national security, in our case, this is for health. We are exclusively an investment agency. We are focused on looking for those breakthroughs in a disease agnostic way. So we look for the problems that are ripe for ARPA-H funding, and then we bring on program managers to pursue those efforts. We launched a few different programs, but the one that you asked about today, Heroes, is a pretty non-traditional one. Heroes stands for Healthcare Rewards to Achieve Improved Outcomes. And what we're trying to do with the Heroes program is to incentivize ways to really prevent disease. The United States, unfortunately, suffers from many preventable diseases that we believe if we incentivize the marketplace to bring forward new innovation for things like maternal health, for substance use disorder, for even stroke, cardiovascular disease, that we can create new paths to bring innovation forward. In this program, what we would set up is ARPA-H would be a first-in funder. We would be looking to fund teams that have actually propose a strategy. How would they really address some of those health challenges that I described to you? But we'd also be looking for those teams to bring other investors to the table. So after our initial investment, we actually have a sustainable way to incentivize those types of interventions. And so it's a big experiment for us, but we're really excited to be kicking that off here in the next couple of weeks.
Yeah, it's really interesting to me just the way this is set up. I know you've answered a number of questions over time about what exactly do you do, but how does this really differentiate from NIH? And especially at a time where, to the point of preventable diseases, you're in an environment where even if you do find the solution, you may not necessarily get uptake on whatever the solution is, as we've seen with the vaccines during the pandemic. So talk to me about what role sort of ARPA-H plays there.
Yeah, it's actually a perfect question, and we're really the agency that we think is really to help address that gap. So the bridge between innovating in the laboratory in a small company and bringing that into the real world is incredibly challenging. And we actually have set up an infrastructure that's really focused not only on making those investments in R&D, but bringing them across the finish line into the real world. This year we launched ARPA-Net-H, which is our way of engaging the health ecosystem, not only to bring us closer to our customers, where we want to get that feedback from patients as we roll out new products, et cetera. We don't want to roll it out on the last day and have them not be excited about that. We want them to be a partner in the development of that process. We also, through this network, are engaging investors, ensuring that even if ARPA-H initial investment, that can be very high risk, high reward, we want it to be catalytic for somebody else to pick up that funding on the back end. It's a good comparison, again, bringing up DARPA, where the Department of Defense will often pick up a successful DARPA program and be that number 2 funder. That doesn't exist in the health ecosystem. HHS is not that same entity for the health ecosystem. So we really need to tap into the private sector to bring them to the table very early in the development of all of our programs. And that's really how, engaging both on the front end, the customers, and on the back end, those investors, that we hope to address some of what other federal agencies have so far been unable to do.
Yeah, that investor part is pretty interesting, considering that you're running this based on what I've heard you say in the past. You're running this with a lot of money at your disposal, essentially that $1.5 billion in funding. You've got pretty well-paid program directors, and you're also, in your own words, are looking at sort of bringing things about, bringing big ideas about without the necessity of proof of concept, considering this is a taxpayer-funded program compared to the billions that exist in the industry through VC, through other funding sources. I just wonder how you think about that in terms of what your responsibility is with that funding.
Oh, it's a huge responsibility, but also like what an incredible opportunity that I know our team is really ready to rise to that challenge. And this is really one of the other ways that we differentiate ourselves through the authorities that established ARPA-H. The Congress has given us a use of different contracting mechanisms, different payment mechanisms that allow us to enroll in what I like to call high contact program management. And what I mean by this is our program managers who manage these federal dollars, these taxpayer dollars in programs like HEROES, they actually have a seat at the table. They are one of the decision makers. They're working in partnership with those that they fund. And so this way, if we get maybe 3 months, maybe 3 years into a program, we can make the best use of those funds. Maybe we pivot resources because one effort isn't working. We need to put those resources into another team. These are all tools that are at the disposal of our program managers. And so, really take care of stewarding those federal dollars as we move forward.
Great. Well, I know we'll be all watching with a microscope. Thank you so much. Renee Regerson, Director of ARPA-H.
Great. Thank you very much.
Coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned. That is your closing bell on Wall Street. We're going to get a quick check of the market action here, continuing to see some green across the broad indices here. When it comes to the Dow, up 0.5%. Again, a big pairing of losses there when UNH was bringing them down throughout the day. Now seeing them end in the green, particularly after Apple had such a banner day. That also lifted the S&P 500 nearing 0.9%, and the Nasdaq is up 1.3%. That is mainly off of that Apple upgrade today. And of course, we can't forget kicking off our day with TSMC announcing
announcing a 20% potential gain on revenue year on year. That lifted the entire chip sector. The SOX index was up for the day, and that's what's driving a lot of the trade today, Josh.
All right, let's get you some trending tickers as well. What's moving in today's trade? Birkenstock reporting its first results since going public. Shares sliding despite beating revenue estimates as the company's forecast disappointed clearly some investors. So this one, most analysts covering the name are fans, Madison, but investors not a fan of the stock, at least today. Q4 revenue beat. The company offered some targets, said the top line this year could grow as much as 18%. And it did sound like, according to the reports I was reading, that was actually higher than consensus, but perhaps not high enough for investors who maybe wanted more from the sandal maker.
Yeah, the market dipped as much as 14% on this particular stock, and this did follow a recent run-up in the stock, so that could have been a little bit of the selling of the news, but also investors were looking for a good first earnings print from Birkenstock following their IPO, and that's not what they got today. The CEO also said that they're going to put more money into beefing up production, improving factories, but when I hear that, I hear more costs passed on to my friends who are buying Birkenstocks. Having said that, though, the CEO actually addressed that, saying he's not worried consumers that are buying from Birkenstock have pricing power, purchasing power, so the company therefore has some power to wiggle the pricing with a little bit of inflation there, Josh.
And we were talking there too. We were actually talking yesterday about how this one was primed for volatility. You mentioned that, right? So maybe not too much of a shocker, the kind of swings you're seeing in today's trade.
Yeah, and those margins, a headwind to come. Speaking of margins, let's take a look at a company doing well. Shares of Meta trading higher today. The social media giant providing an update on its efforts. CEO Mark Zuckerberg taking to social media to comment on the massive compute infrastructure plans to support the company's AI roadmap. Take a listen.
By the end of this year, we're going to have around 350,000 NVIDIA H100s, or around 600,000 H100 equivalents of compute if you include other GPUs. We're currently training Llama 3, and we've got an exciting roadmap of future models that we're going to keep training responsibly and safely too.
So trading responsibly and safely being the key terms there. I have to say I was a little bit triggered by his announcement coming on Instagram after what happened with the SEC and X last week, but I guess we're going with this not being a deep fake video of Mark Zuckerberg here. But again, doubling down on AI, right? Talking about bringing major AI research efforts from FAIR and Gen AI closer together. This makes sense. We're continuing to see this across the board here. And also he did mention they're excited about progress on their AI-centric computing devices like Ray-Ban Meta smart glasses. These guys just keep going after things they want me to put on my head, and I'm fascinated by it. Vision Pro, Meta glasses.
Yeah.
I don't get, it messes with the eye makeup. I'm not fully sure they're doing the market research on the ladies here, but they continue to be excited about it.
It's interesting because it's how investors, looking to obviously play the AI trend, and they've piled into Microsoft, they piled into NVIDIA, but another one they've looked to has been Meta, and as many clearly think it's a smart way to play this theme. And Zuckerberg has, in the past already talked about how, the technology is improving recommendation systems and user feeds. Sure. That stock was a monster in 2023, but we've had smart analysts on here say it still looks attractive even at these levels. Earnings coming up, by the way, February 1st, so I'm sure we'll get more info and insight from Zuck at that point about this. Yep. Meanwhile, to get a quick look at shares of Spirit Airlines, still under pressure here. The airline reportedly examining restructuring options. That's according to the Wall Street Journal. Although then we had another headline drop here, Madison, saying that Spirit is actually looking at options to refinance its debt. It's not considering restructuring. That's according to Reuters citing sources. So some conflicting headlines and articles here today. Obviously, the company stock has been hit after a judge blocked that merger with JetBlue. Fitch weighed in this week, too, said its credit profile was under pressure as it was facing some refinancing risk, other issues, competition, labor costs. One big name entering the drama, by the way, we have to mention, Dave Portnoy, Barstool Sports fame, announced he bought the stock, and then bang, we get this headline, initial report saying Spirit was considering restructuring, the stock drops hard, although, yes, it finished down today, but well off its lows, so maybe the Portnoy effect.
Yeah, it's interesting because in a post he talked about how this was one of the initial stocks that he invested in when he started his day trading, and it went up at that time when Berkshire was pulling out of the name, so he felt like he was rah-rah over Warren Buffett on that front, getting back in this name this time around. But as soon as he got into it, like you said, Josh, the stock continued to tank. That stock is down a whopping 70% just since that judicial ruling. That was this week. I mean, this is not a good week for Spirit Airlines here.
No, rough looking chart.
Yep. All right, well, as markets continue to face a broader January slump, Wall Street is eyeing what may be the key to turn the market narrative around. Here with the details, our very own Josh Schaefer. Josh, what do you got?
Yeah, Madison. So I was taking a look at just the overall market action today and sort of what we've been following that could maybe bring us higher. We've had kind of a dull January, right? But now we're back near record highs, and taking a look at what drove that today specifically, some positive big tech highlights, right? It was big tech really kind of driving the narrative here. We saw Apple up over 3%. Technology itself, the sector was up almost 2%. And it just sort of reminded me that we spent a lot of the last 2 months talking about that soft landing trade that we've been talking about a lot on air, and all those other areas of the market, the other 493 stocks, not the Mag 7, right? But strategists right now are highlighting technology can still play a big role here, guys. And we're coming into big tech earnings. Next week, you're going to get Tesla and Netflix, and then we'll probably expect Apple, Meta, and so on and so forth, Microsoft the week after. And just when you think about how much these stocks are a part of the S&P 500, you're talking about tech, about 30% of the S&P 500, the tech sector itself, which of course doesn't even include Tesla and something like that. And strategists basically highlighting to me that we need to see good earnings from tech in order for that to be something that drives us further. And I think today you even saw a good example of that with Taiwan Semiconductor, right? They played that. What were the two letters they said? Was it AI, right? That still works, huh?
We still don't remember. I mean, what is it? We haven't heard enough.
Right, but
you want to sprinkle AI on everything, Josh.
Yeah, but I think it's positive for the market to see that being something that investors are still responding to, right?
Yep.
When you say AI is going to drive 20% revenue growth in 2024 and your stock goes up 9%, I'm happy if I'm a tech company that's reporting in 2 weeks and I know I'm going to be talking about how AI is driving things. Mark Zuckerberg talking about their success with AI today, and you see that stock up over 3%. So perhaps as we get to earnings, we know that's what the market bulls were yelling at us all of January. Just wait till earnings. Wait till earnings. Then we'll see that narrative shift. And it seems like at least for one day, only one day, but we saw that start to happen today.
Some green today. Our earlier guest, too, was talking about this, Brett Nelson. He said last year the pivot from the Fed drew up the market, and this year it's show, not tell with those earnings. So exactly to your point, Josh. Thank you so much. Really appreciate you joining us here on that. Also, zeroing in on shares of Taiwan Semiconductor jumping today, boosting other chip stocks as fourth quarter results suggest that the worst could be over for the sector. Now, that comes after economic data out of China disappoints, and weak demand out of that region pulling down even some of those beloved Magnificent Seven stocks. So which story is going to drive stocks this earnings season? China's economy or the company fundamentals? We're going to bring in James Early, BBAE Chief Investment Officer. We've also got Dory Wiley, President and CEO of Commerce Street Capital, joining us on this. Thank you both so much for being here. James, I want to start off with you. We had that great news on TSMC driving up the SOX index today. Bad news, though, out of China, and you're a great person to talk to on this because of the amount of time you've spent over in that region. So I'm curious, what do you think will impact the future of this index, the semis index specifically more, that news coming out of China or the company-specific news?
I think it's going to be the company-specific news. I don't think the Chinese economy is a big driver for semis. The driver there is probably regulation. But going back to the Chinese economy, I would liken it to the adult child who's trying to move out of his parents' basement, but is just having trouble doing that. And by that, I mean, the economy has been trying to get on its own feet in a consumer spending sense. It's about 53% of the economy right now, whereas the U.S. is about 68%. But they're just struggling, Madison. They're struggling. And so they're going back to that government playbook of heavy spending, heavy infrastructure spending to try to drive the economy. That's why the market's down. For the semis specifically, though, those things are not driven by consumer demand. That's more of like a Starbucks story or maybe a Tesla or an Apple story. The semis are trying to do as much buying as they can, the consumers of the semis, before more regulations strike.
And Dory, let's bring you in here as well and stick with that semi theme here, because one name you like, Dory, is NVIDIA. Obviously, a lot of people like NVIDIA, Dory. Its stock is up about 230% in the past 12 months. What do you think, Dory, as an NVIDIA bull? What do you think the near to intermediate term catalysts are here for this stock? And what do you think also the risks investors should consider before piling in here?
Well, kind of going with your overall theme here, it's really AI, right? And so if you're a money manager, you got to have exposure to Mag 7, and if you have exposure to Mag 7, you got to have exposure to NVIDIA, and AI is very real, and it's going to be even more real going forward. Now, these other semiconductors, I like TSM, I like some of these others. It's really, but I don't like the exposure to China. I don't like it right now. China's almost uninvestable. And that's hard to hear from an investing point of view because we try to keep politics out of it. But there's so many fundamental reasons to try to avoid China as much as we can. So the less exposure I have to China, the more I'm into AI and semiconductors. That's kind of what I'm looking for, because China, there's just, exports are down, population's down, the market's down 30%. It's the third straight year. A estate debt issues, government debt issues, no new construction, and their politics has gone from a party dictatorship to a person dictatorship. So they're moving the wrong direction. And then what no one's really talking about is all the price deflation that's going on over there, and it's pretty severe.
All right, so James, I got to get your response to this. Dory calling the region uninvestable. What is your take on how investors should or shouldn't be playing China?
Well, let me say this, Madison. I agree with Dory personally. I'm not a big investor in Chinese stocks, and I say that as someone who spent 10 years of my life doing business with China. But I can hold two ideas in my head at the same time. And there are a lot of people smarter than me who might make a lot of money buying China now, because the silver lining of all this drop is prices are cheaper than they've been in years. Property is way down. Everything in a free market sense is looking poor in China, but this could be the time to buy. The blood could be in the streets if you're a bull. If you are a bull, I'd look to the industries that are most likely to get government love. And I would put banking at the top of that list. No matter what happens in China, the banks are not going to go under. And some of them pay 6, 7, 8% yields. And so you could buy a MSCI ETF. I think CHIX is the China Financials ETF, has 100 stocks, or about 100 stocks, and has a 6% yield. That's probably one of the safer China plays. If you want to take more risk, you could go into some of the bigger internet names like KWeb. This is a Crane Shares China ETF, has 30 big tech stocks like Tencent, like Alibaba, like Jingdong. These companies, they're not going to get as much government love as the banks. And then the government has a love-hate relationship with them. They like that they're national champions, but they don't like that these companies have a lot of data and therefore a lot of power. And the Chinese Communist Party likes to have all the power. But the government is not going to kill these companies. They got too much data, they employ too many people, and their products are used day to day by everybody. You can't do anything in China without WeChat, including interfacing with the government. So KWeb could be a safe play. Jingdong down 60% in the past year if you want an individual name.
Really good overview on that market, James. Dory, I want to go to you stateside, and let's talk about the Fed elephant in the room here. To what extent could Fed movement impact pricing in some of the big tech names that we mentioned? And what is your take on the broader consensus around the amount of rate cuts that we can expect to see this year?
Well, sure. We had this rally at the end of the year, obviously. And to me, it was a market-based rally on 6 cuts and the pivot. And obviously, the Fed's walking that back. I'm not sure why they were so dovish in December anyway. But now that you had a couple of Fed speeches this week, they're walking that back. I'm more of a 3-cut guy this year. If that happens, later this year, we'll see. The economy's been pretty resilient. They seem to have a pretty good shot at a soft landing here. And so they certainly deserve the benefit of the doubt right now because the data's there. But that means the market's rallied for the wrong reason. And so it's backing off already this month. We certainly are seeing that in some of the banks. Banks are going to kind of hang in there until credit problems show up. And what that does for the tech stocks, right? Because those, lower rates obviously are, better for them. I just don't think they're going to see that. So I think the market's going to be soft over the next 30 to 60 to 90 days. be a great time to pick and choose getting into the right investments, whether that be banks or some of the big tech. It'll be a stock pickers market over the next 6 months.
All right, so really quickly, in one sentence there, Dory, how would you describe the market pricing of those 6 cuts?
Oh, those 6 cuts? The market pricing on what? Help me out here.
Market pricing on Fed cutting 6 times. What do you think about that consensus?
Oh, I think that's way off. The market's been wrong for 18 months, which is a terrible thing to say. The market's always right, but it's been wrong for 18 months on timing, right? And so we investors have a hard time timing, and so does the market. And so I just don't see it. And the Fed's fighting it, right? They're going to talk back this bullish market as it gets out of control. The only thing's keeping them, keeping them where they are. If you look at jobs, I mean, so the unemployment's being supported by what? Increasing government jobs, right? And that's still not what we're really looking for.
And James, I'm going to give you the last word here. Any thoughts on how the Fed is impacting your investment outlook for this year?
Well, I agree with Dory. I mean, the Fed was telegraphing 3 or 4 rate cuts. The market was expecting 7. The Fed's right. People are way too optimistic on tech stocks. Equal weight S&P was barely up last year compared to regular S&P. I think we may see the reverse in 2024.
All right. Well, thank you both so much for joining us. I love that conversation. Dory Wiley and James Early. Thank you both so much. We're going to continue our coverage here. Coming up, mortgage rates decreased to the lowest level since May of 2023. Could this be the year the housing market rebounds? We're going to discuss exactly that on the other side of this break.
Stocks turning things around, finishing the day higher thanks to big tech. Jared Blickery is here with a look at today's comeback. Jared.
Thought I'd start with the record highs, and we got a lot here. Microsoft up over 1%. NVIDIA to a record closing high. That's up 1.88%. Visa, whether you classify it as fin or tech or fintech, nevertheless, that's at a record high, up 0.5%. And just really a broad swath of industries represented, from Costco to MasterCard. We also see T-Mobile, so telecom, looking at staples, financials, chip stocks, pretty broad swath here. Even O'Reilly Auto Parts up about 2.36%. And let's take a look at the sector action. I was talking in the last hour about the dominance of tech, not only last year, but this year. And guess what? Right today, it is up about 2%, and it's followed by industrials and communication services. Now, industrials a little bit newer to the mix. We saw it really come into its own in November, December of last year, but bottom line is all three of these sectors are outperforming, and what's lagging is telling, because those are the defensive sectors. So that's actually bullish. Take a look at utilities, down 1%, real estate, that's down 0.2%, staples, even energy, slightly defensive, healthcare, arguably defensive. All of those in the red today. And let's just cycle through some heat maps to see where we stand at the end of the day. So here's the Nasdaq 100. Apple, you're going to notice here, Apple is not on top anymore. It used to sit there for years and years. It is now second to Microsoft. So Apple up 3%. Nice to see those gains, but still second to Microsoft in terms of market cap. Alphabet and Nvidia and Amazon each up more than 1%. Meta up more than 2%. But Tesla has not been able to catch a break this year, down 1.7%. That's down about 16% for the year. And let's take a look at energy. This is one of the sectors that was lagging. You can see kind of a mixed board here. The American majors in the red, while some of the European majors in the green. Just for example, Exxon down 0.2%, Shell up 0.5%. But when we take a look at China, that's been one of the real sore spots over the last month. Just talking with a prior guest about potential investments in China, not looking the best today. We got Pinduoduo down just slightly, but Alibaba down another 1%. And if we take a look at the year-to-date losses, that's when we really see some dark red guys. So all in all, tech doing well in the U.S., but not necessarily in China.
All right, Jared, thank you so much for that market overview. We're going to pivot over to housing because we got lots of housing data out today. Building permits continue to rise, but housing starts trending down for the first time in 4 months. Builder sentiment keeps surging, but not necessarily when it comes to single-family housing. So to make sense of the highs and the lows in today's data, we've got the perfect guest on this, the CEO of the National Association of Home Builders, Jim Tobin. Jim, thank you so much for coming on our show today. I know that in 2022, after a big drop in home builder sentiment, you said that we were heading towards a housing recession. After all of today's data, how would you describe what we're heading towards?
I think we're heading towards a housing renaissance. I think 2024 is shaping up to be that pivot year where we leave the doldrums of kind of the post-COVID slowdown, and we really pivot into the next 5 or 6 years in the housing market, where we're going to see some great growth. We're going to see home builders meet that pent-up demand for single-family and multifamily housing. So I'm very optimistic. The headline numbers that we saw when it comes to starts and sales and permits, I think we have to understand we had some bigger numbers earlier in the late half of 2023, and now we're looking for 24 to really take off.
And Jim, let's talk about affordability, though, as an issue. Now, I'm looking at the 30-year fixed here, Jim. According to Mortgage News Daily, says it's now at 6.89%. I mean, it's better than 8%, Jim, but it's still higher than a lot of people are used to. How does that impact demand, Jim? And where do you see that headed from here? Where are we in 6 months?
I think in 6 months, we're going to see mortgage rates even lower than we are now. We watched the Freddie Mac numbers, and they are showing that we are closer to 6.5 than we are to 7, which is a good sign. We're already starting to see across the country that people are coming off the sidelines. As you are the NHB Wells Fargo Housing Market Index, which came out yesterday, the biggest jump in that component, we moved up 7 points in total, but the biggest component jump was in traffic, which means people are starting to get out of their homes and get into model homes to look at housing, maybe setting themselves up for a spring buying season, readying themselves for those lower rates. So I am encouraged by the trend. We're down just over the last couple of months. We're down over a full percentage point in mortgage rates. And then when you couple that with builder incentives, people are getting actually below 6%, whether it's mortgage rate buy downs or price cuts. Our builders are doing everything they can to get those buyers that are in the marketplace into those new homes.
So I'm curious about exactly what you just said, that rates are going to be lower in the next 6 months. Where are you seeing evidence that people aren't holding on to their mortgages, holding on to homes in anticipation of lower rates in those next 6 months?
Well, I think that the world is getting ready to realize that we're no longer going to back those 3% and 4% mortgage rates. And there does need to be a generational shift here that the mortgage rates in the 5 for the long term are still really good low rates for a long-term investment like your home. So I think people are going to recognize that. Again, 6 might not be quite the number they're looking for, but they're going to start moving off those sidelines. I'm convinced of that, especially as you start getting down lower towards that 6. And again, with incentives or those government programs that can help people get into homes, I really think that we're going to start unlocking those people that are rate locked in their existing homes. We're going to start freeing up the existing home supply, which is going to further add to what the home builders are putting on the market now.
And Jim, I'm curious too, just in terms of supply, can builders now, Jim, can they develop new homes faster than they used to?
No, actually, it's much slower. Governments, local governments really control the land use process and the land development process, and then they control the permitting process. So all of that is in some markets, local governments are very much a partner with home builders and development. In many markets, they are not, quite frankly. And if this is the year where we're going to begin to pivot into a stronger growth cycle where housing can meet that pent up demand for single family and multifamily housing, then we need local governments to help get out of the way, find ways to reduce permitting times, move land development costs along, find more land for development. That's what we need in order to put more supply on there. And we also need our partners in the supply chain, whether it's lumber or wallboard or shingles. We need those supply chains to be ready and listen to us that we are about to come into a pretty high growth time and get those supply chains ready so we don't go back to where we were in 2019, 2020, and 2021 with high lumber prices and slow delivery times on key products for homes.
And Jim, we've talked with you in the past about another challenge, which is labor. I'm just curious to get an update there, Jim. How does that look? Is that still a challenge for the home building industry?
Still a challenge. We are consistently about 400,000 jobs short year over year, month over month in the construction industry, and that will continue to be the single biggest drag on our builders. I'm actually here with builders in the Midwest. I'm actually in Fargo, North Dakota. Yes, it is cold as you would think as it looks on the thermometer. And I will tell you that they are very excited about the future here in Fargo. It's a high growth area. People want to move here. However, labor is the number one issue I've been talking to them about, and just the lack of labor. And if you can find labor, it's cost and then the time it takes to get them on the job site. So labor is always going to be an issue. And that's why we need to make sure we're investing in trades and getting our young men and women invested in working in the trades, because that will help build affordable housing in the future.
Jim, I am selfishly seeking your advice on a first-time home buyer situation here. We know that single-family housing starts fell 8.6% for December, despite that pent-up demand. What is your single biggest advice for someone who's seeking single-family housing as a first-time home buyer in this market?
I think now's the time to get out and look at a new home. As the existing market, which is traditionally where first-time home buyers look at an existing home, don't be afraid to look at a brand new house. They are on the marketplace, and it's time to look at new construction. I will also say, for a first home buyer in particular, there are government programs that can make low down payments available to you, or even zero down payments. There is an opportunity out there. Do not be scared off by 10 or 20% down payment options. The government is here to help specifically new home buyers realize the dream of home ownership. So now is the time to start looking and get ready for not only lower rates, I hope in the spring, but also that now is the time to really take a look at housing.
Jim, always love having you on the show. Thank you so much for your time and insight.
Thanks for having me.
And now some breaking news here. Macy's reportedly planning to lay off about 13% of its corporate staff and close 5 stores. The retailer looking to add more automation to its supply chain and outsourcing some roles. This all according to the Wall Street Journal. Shares of Macy's right now in the after hours, marginally lower, down about 0.5%. So per the Journal, Madison, it sounds like we're talking about in total here 2,350 positions. That would be about 3.5% of the total workforce. Where's the company investing? It sounds like areas that impact consumers. So think about visual display managers, upgrading digital functions, and all this coming, we know, as Macy's president, Tony Smith, is going to be taking over as CEO next month.
Yeah, it's interesting because when it comes to earnings, Macy's has been outshining some competitors when we think about names like Nordstrom, Kohl's. But these layoffs could be a move to continue some of that upward movement, cutting about, again, 13% of its corporate staff. They did mention in this WSJ exclusive that Macy's is planning to add more automation to its supply chain. I want to double click on that because it seems as if we're hearing more of these executives talk about AI as sort of a talking point, an excuse perhaps, when they announce these layoffs. And they do say also that these layoffs are going to occur on January 26th, this becoming the latest company name to announce job cuts this year, Josh.
Yeah, remember, this is all coming, of course, as Macy's is dealing with activists who reportedly did make this nearly $6 billion offer to buy Macy's, take it private, as it is dealing with this tougher competition. So, story we'll keep watching.
Yep.
Meanwhile, coming up, Ford CEO Jim Farley has big plans for the car maker in 2024. More on their electric vehicle strategy. It's coming up next. Shares of Ford had a tough run in 2023, weighed down, of course, by labor strikes and cooling EV demand. But Ford CEO Jim Farley was in a celebratory mood yesterday in Charlotte, North Carolina. Praz Sumeranian joins us now for more. Praz.
Yeah, Josh. So, in Charlotte on Wednesday, Ford sort of previewing their motorsports endeavors here, taking Mustang, not just from NASCAR, but also in Europe with Le Mans. They call it the GT3 class. They're putting Broncos and a Raptor truck in the Dakar rally in Africa. So a lot going on there because from Farley's point of view, he sees motorsports as like a sustainable business in terms of like it can make money. And it can also highlight the passion cars like Bronco and Mustang that he's also a fan of. But also, we spoke about 2024. A big year last year in the books, labor disputes resolved, some EV issues there with demand, things like that kind of being addressed there. But he's actually very bullish on where 2024 is headed this year.
Well, I've been leading the company for 3 years, and 2024 is the first year I can say we really have a chance to have a breakout year for a lot of reasons. We're past our labor issues and negotiation in the US, but most importantly, we're launching like 6 new products, and we already have a fresh new lineup of Broncos and Mavericks, and but now we just launched Super Duty, and we have the new Mustang, and we have a new Explorer and Expedition, and a new F-Series, America's best-selling vehicle for 47 years. We have this lineup we've never had before, and the consumer's strong, interest rates are moderating, so payments aren't going to have the same escalation we saw last year. And our demand and all the chip issues and supply issues working through, and now we have real traction on quality. So this is without getting into specifics, as you said, we have a chance at Ford to really have a very special year.
And a lot of new cars coming up, some EVs as well. We've seen in this country EVs, that big transformation happening. A few hiccups here, maybe it's because of pricing or just demand or range anxiety, things like that. But from your point of view, what's going on in the EV landscape first, big picture, then also with Ford as well?
Well, the big picture is that China makes 50 to 60% of all the electric cars on the planet. And so big picture, we have a whole new competitive set we never had. And now China in the first quarter last year became the #1 exporter of vehicles globally. Bigger than South Korea, bigger than Japan. We've never seen a competitive set of EVs exported now. Now 1 out of 4 vehicles sold in Mexico, which I can drive to from Detroit in a day, is built in China. So China exports and EVs, big topic. The price compression after Tesla dropped its prices with the new competition from Ford. We're #2 in the US now, a long way from Tesla, but we're really growing. Our fourth quarter and Lightning sales were up, a lot. So we're starting to scale. We just broke 100, we're close to 150,000 units now, about 10,000 a month of sales in the US. So our EVs are growing, but the prices have come down. And what that really is telling us is that it's mainstream customers now. They're not willing to pay the same premiums as early adopters. And we're also seeing we're #2 in hybrid. So at Ford, we have all this choice, an F-150 electric or a hybrid or an ICE, we don't really care, let the customer choose. We're starting to see hybrids and electrics take off at the same time, but the prices become more similar. And so I think what you're seeing is a natural rationalizing of this new technology by the customers. We're seeing mainstream customers who are interested in EVs, but they're not convinced, and they're not going to pay a big premium. So what it means for the OEM is cost. We have to dramatically reduce the cost. Thankfully, we thought this was going to happen. We weren't sure. And so we're just a few years away from launching our Gen 2 products, which no one has seen. And those are really oriented around a different cost level. And we could talk about that if you want. But to me, the whole thing about EV is the same as any technology transition we've had in the US, in our industry. It's cost. We have to be competitive on cost and quality.
Cost, and then also how you make these cars and how they're designed. I know you talked about the software-defined vehicles, how important that is for you and the new leadership there in the company.
Yes.
I got to drive with you in a demonstrator, they call it. This thing was, I'm surprised I didn't throw up in this thing. The Ford Supervan with, 2,000 horsepower? Something crazy
it's
like
very
that.
modest.
We drove around the track here in Charlotte. But is that sort of showing us a vision of what EVs can do and what the future is?
I think, a lot of the hybrid and EV technology came at the market in very rational cars. And they were very commoditized, like Prius or Model 3. And, for us at Ford, we are not a commodity company. We make Broncos and Mustangs and, pickup trucks, and people are really emotional about our product when we do it right. And so we wanted to create Supervan to kind of show people, even in a commodity commercial vehicle. That electric can be different and cool. And it's not just electric, it's a digital product, just like your phone. We can ship software to it, we can change the performance. And the sports car of the future, like a Mustang, may be partially electric, fully electric, or ICE, but in either case it's going to be connected, and we can control the performance with software. Change the torque vectoring with the motors in each of the wheels in this case, or change the damping or the braking characteristics with your phone. That's the future of our industry.
Yeah, I don't know if that 2,000 horsepower electric van is the future of our industry, but one thing I did see was a thing called the switchgear, which is an F-150 Lightning EV. That's basically a Raptor off-road. I got a ride on this thing with Vaughn Gittin Jr., who is this like a drifter guy. And he took this thing and he drifted it around this course, and I was sitting in that truck, and it was really cool. So and that's just showing us where EVs could possibly go.
Yeah.
Immense power, extreme torque, that sort of thing. Applications that we don't think of. We think of EVs as like races driving around, but actually you can do some cool stuff. And I think that's what they want to highlight with these demonstrators, they call them.
It's a great, first of all, why do you get all the best assignments? Why is that? That's not fair.
So cool.
It was interesting because there is this big issue that we talk so much about, Pras, about just this question of whether we kind of overstated what EV demand really is in North America. And you heard the argument. Some people would say, listen, you can have the government encourage and motivate and give the subsidies, but at the end of the day, Americans, they prefer a pickup. But I guess his point was he really thinks first and foremost, it's price. That's the issue.
Yeah, he's sort of taking that side of it where if I build a car that you can afford, you're going to buy it, no matter what kind of powertrain it is. Now, I'm not sure if he might be right, he might not be right. We were seeing these issues with people driving these EVs in Chicago and colder places and having problems.
Yeah, that was a brutal article.
Yeah, they may not want an EV no matter how cheap it is, but I think he is hitting something on the head there. As Tesla brought those prices down, they sold 660,000 EVs in this country. Maybe there is untapped demand if the price is right. So we'll see if he's right, and I think that's where they want to go. Also with these software-defined vehicles, make them cheaper, make them use your phone to do whatever you want. I think that's sort of what he thinks is the future for EVs.
Was there anything surprising real quickly about his personality? He spent so much time with you. Like, that was a very generous CEO.
Yeah. I mean, I've seen him at Pebble Beach last year and things like that, and he's the kind of guy that's really passionate about cars. So I think he sort of, if he sees you have that passion, he wants to talk to you more about it. And I think he's a true car guy. And I think this is one of the differences we've seen with Mary Barra being an engineer, actually, Farley a car guy. You've seen people who actually care about the industry being installed there, and they seem to be doing well as opposed to maybe some finance guys who may have been put in place to count, pennies and dollars and staples.
Different executives,
Great story, Pras. That was great.
Pras, thank you so much. We really appreciate it. Coming up, we've got our very own Brian Sozzi and Julie Hyman. They are, of course, at the 2024 World Economic Forum in Davos, Switzerland. They'll speak to the CEO of Suntory to discuss consumer appetite for company brands. Stay tuned for more.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
There's more going on here at the World Economic Forum in Davos, Switzerland than talk about AI. Lots of food and beverage companies here are trying to understand how climate change may impact their business. Let's talk to one of those very large companies. Suntory CEO, Tak Ninami. Tak, good to see you in person for a change.
Good to see you.
Appreciate it.
Thank you.
So what has been your biggest takeaway so far from the conference?
Possible escalation of the Middle East crisis that may affect the world
supply chain in terms of cost increase, and perhaps energy cost might go up again. So that's a huge risk. So things are more complicated than I thought.
So what is Suntory doing to try to prepare for maybe that happening as we see especially more shipping problems through the Suez Canal and the Red Sea?
Well, first of all, we are now piling the inventory, and we ship as early as possible. In 22, 23, so many our products are afloat. So we have to avoid, and our logistic team is very much agile to secure spaces now. But I think the travel time, shipping time is expected to be more than current, so maybe 1-2 weeks more.
Do you anticipate any product shortages? Do you have to take price increases to support those pressures?
We are now considering, but in the US, for example, consumer confidence is waning. So anytime soon, perhaps that will go up. Depends on the scenario of the interest rates led by Fed. So around the world, I think we want to increase, but the situation at this moment is worse than last year.
And for people who don't realize, Suntory, I believe, is the #3 maker of spirits globally, right. But you make much more than spirits, and you make a lot more than Japanese whiskey, right? Sauza Tequila you own, Jim Beam, Orangina, also other soft drinks, beer and wine as well. So when you think about, just to expand on that pricing strategy a little bit around the world, what kind of pricing power do you have? Did you take a lot of price increases while we were seeing inflation in the US, for example, and now kind of where are you on that front?
Two things. First of all, we keep premiumizing our products and focusing on premium and a bit premium instead of super and luxury, which is under attack from the current trend of consumer inconfidence. So we focus on the premium again, and the tequila, American whiskey, and the Japanese whiskey. Whereas we want to respond to the current trend of Gen Z, who is not drinking a lot. And they are drinking seltzer, RTDs. So we are #3 in RTD segment. So we want to enhance the current
ready to
trend.
drink, that is.
Yes, ready to drink. So we have a bold plan to expand our business of RTDs in the world, including US, including China, including India.
Just staying on the Gen Z, I didn't realize this, maybe because I'm old now. Half of Gen Z is reaching the legal drinking age by the end of this year. Why do you think are they not drinking as much? Is it a health thing?
I think health conscious as well. And somehow they don't want to drink just like their fathers, mothers. I don't think mothers, but more or less, there's a social divide in a sense. They like definitely the companies are dealing with the social contribution and environmental sustainability. Their, I think, value standards are completely different from my generation. So in that context, they are different, and they like the difference. So less drinking and enjoy, meeting people. But I think that is a huge trend we have to be concerned about in terms of increasing the spirits.
Your business, incredibly well run for many decades. And one of the benefits of that is you have a lot of cash and you can do things. Do you want to create brands out of thin air from the development team, or do you want to go out there and acquire brands like we've seen in recent years from the industry?
Well, switching brands amongst our competitors, that's a regular transaction. And we'd like to increase our portfolio of tequila, for example. And we will increase the exposure of Japanese whiskey or Scotch, which we produce based on the Japanese craftsmanship in Scotland. So we are spreading to create new brands based on Japanese craftsmanship. And we work together with the local craftsmanship. So, excuse me, we are going to increase Scotch, Japanese whiskey, tequila, American whiskey. based on the more upgrading the quality, and instead of just the marketing, but we want to demonstrate that we are the quality player.
And speaking of which, Japanese whiskey, just like Scotch whiskey now has, and I believe Kentucky whiskey now has a definition, right?
Mm-hmm.
So talk to us about that and what that has done to the reputation of Japanese whiskey in other markets.
That's a concerning factor. As a matter of fact, from April 1st this year, the Japanese whiskey definition will be very much strict, which means you have to produce in Japan, and you have to use Japanese whiskey. You have to age in Japan more than 3 years. Those definitions at least guarantee the quality of Japanese authentic whiskey. But I'm afraid to say quite a few un-Japanese whiskey, but saying Japanese whiskey. So from the 1st of April, we will demonstrate to the clients, consumers, authentic Japanese is Japanese whiskey. So we, Suntory, produce and supply only Japanese whiskey produced in Japan. So watch out, and we'll give a guideline to clients.
Well, I'm not part of Gen Z, but I am a millennial that enjoys your products. I had to say, I don't know what Gen Z is thinking about. Nonetheless, Suntory Holdings CEO Takanami, always a pleasure to get some time to appreciate. Thank you so much.
Thank you. Well, those business and world leaders heading into the final day of the annual meeting of the World Economic Forum in Davos. Our very own Julie Hyman and Brian Sozzi again spoke with several top executives attending the summit this week about how they lead with success. Take a listen.
I always find ways to make time for new things, new people, and I guess I really value the people interactions and being kind in every interaction and trying to help others, because I feel like I've been very lucky to be helped by other people through my career, and so just to take the extra minute is important. And then there are certain things I just know I'm not that good at them, and I have somebody who's working with me that can do those things better, and I'm very happy to have them take care of it.
I'd say managing human capital is a much more complex process today to take advantage of this rich tapestry that we have and build a common sense of purpose and a common sense of drive and common sense of desire for excellence when you have such a diverse group of people with different reasons for work, different purposes for living, and it's fundamentally changed the way that we think about building great companies.
Diversity is so important. Diversity is the key source of the innovation, and it's more important. And because to respond to the so many issues, but we need lots of ideas to respond to the issues with agility. So people. So we keep investing to people and trying to train them and give more opportunities.
You trust the organization that every role is important, and they give you a role and you add value into the role and you move on to the next role. So what I did was I got a lot of diverse experiences in different businesses in different countries. I worked in India for sure for a long time, and in UK for many years, and I'm in US now for the last 10 plus years. So I think it's a diversity of experience and willingness to take some personal risk. If you don't take risk to yourself, to say, if you want to find a perfect job, it doesn't exist.
Time now for What to Watch Friday, January 19th. On the housing front, existing home sales are out at 10 a.m. Eastern, expected to edge higher from November. The report giving us more insight into a housing market where home builders are confident, but home buyers still struggling amid high prices and tight inventories.
And we're also going to get a look at consumer sentiment, which is expected to hold steady from December. The market's also been keeping a keen eye on consumer inflation expectations. That's forecast to show that consumers' one-year outlook for inflation will hold at 3.1%.
And on to the Fed. A few Fed officials will be speaking, and investors will be listening for more clues about the path of Fed rate cuts. Chicago Fed President Austin Goolsbee is slated to make a TV appearance in the morning, and then in the afternoon, we're going to hear from Fed Vice Chair for Supervision Michael Barr and San Francisco Fed President Mary Daly.
And moving over to earnings, more regional banks reporting tomorrow, including Comerica, Ally Financial, and Huntington Bank shares, all for the fourth quarter of 2023. Now, we have some breaking news we want to get to because a government shutdown will be averted. The House is in the process of voting on a stopgap bill to fund the government. The U.S. House, again, clearing that vote measure stopgap funding into March to avert the shutdown. So, Josh, this means that this will just, again, kick the can down the road. The House has voted to pass that stopgap funding, but that vote continues to be ongoing here. And then they'll have to do this all again in March. But it is kind of clearing that threshold a solid day early. I mean, this is a record for Congress here, at least getting this done a day out when it comes to this spending bill and averting that potential government shutdown.
Yeah, we did have some folks, though, some kind of policy gurus. And I remember on the program, kind of leading up to this and getting their expectations. And some of them were expecting this. They were expecting that we would avert this kind of partial government shutdown, in part because if you had the shutdown, really everybody loses. America blames everybody, so no one wins. So
right.
why not kick it down rather than suffer a bad poll number, right?
Yeah, absolutely.
All right, meanwhile, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and, of course, after the closing bell.